Hi guys, welcome back to TobyUnravels. And as I have told you from the last video, we are going to talk about the evaluation of profit centers. We are going to talk about the different performance evaluation measures, and this would involve 1. Variance analysis, and 2. Segmented income statements. First, variance analysis. Variance analysis pertains to the comparison between actual and expected results. Well, at the onset, you have an expectation as how results should go. Then compare this with what actually happened when they already happened, and there you go. You have a variance, a deviation from expectation. This deviation from expectation can be compared and investigated. According to the principle of management by exception, we are to investigate only significant variances. We should not focus our attention to those variances that are immaterial or very trivial, but rather focus on those variances that would mean something. Variance analysis can be used to evaluate cost centers, revenue centers, profit centers, and investment centers. That is, variance analysis can be used with any type of responsibility center. Now, the main event for our discussion would be the segmented income statement. Income statements generally pertain to a part of the financial statements that is used for external purposes. That is, investors and lenders generally are the ones using it. They are the income statements that pertain to the entire company, results or performance of the entire company. Usually, we use the functional method in preparing the income statement. That is, we are going to classify costs based on whether it's product or a period cost. For our purposes, however, we are going to talk about segmented income statements. That is, in responsibility accounting, our intention is to evaluate a part of the organization rather than the whole of it. In a segmented income statement, we prepare for each segment or department an income statement which shows its revenues, costs, and expenses. In this type of income statement, we are going to use the contribution margin approach. That is, we're going to classify costs, variable versus fixed. We are also going to use variable costing. That is, we are going to treat fixed manufacturing overhead as a period expense rather than as part of your cost of goods sold. To demonstrate how to prepare a segmented income statement, let us proceed to the following case. Ella Holding is a conglomerate engaged in real estate, manufacturing, mining, power, retailing, and banking. Its power plant segment, Electro Corporation, has shown the following data for the first year, that is 31 December 2019. We have revenues, 3 million, variable costs, 1 million, fixed costs controllable by Electrocorp's general manager, 800,000, fixed costs controllable by Ella Company's president but traceable to Electrocorp, Ella Holdings head office common costs to be allocated to its business units, 25% of which is to be allocated to Electrocorp, 800,000. Now, what we're going to do first is to prepare a segmented income statement. Remember that we are going to prepare the income statement only for one of its segments. In this case, it is Electrocorp. Ella Company as a whole will have an income statement for purposes of external usage. But for our purposes, we're going to prepare the income statement only for ElectroCorp, which is for internal evaluation. Let us now prepare the income statement of ElectroCorp, a segment of Ella Holdings. We are going to begin with the revenues. Revenues, we have 3 million. Of course, the first line of deduction would be the variable cost. Variable cost, 1 million. You have a difference of 2 million. We call this the contribution margin. Next, we're going to deal with the fixed cost. When it comes to the fixed cost can be traceable or directly related to the operations of the business. In this case, ElectroCorp would have power plants. Perhaps it would include those salaries pertaining to staff in the ElectroCorp's power plant, as well as depreciation of the plant. And we also have those costs that are simply allocated yet incurred by top management. We will first deal with the traceable fixed costs. Traceable fixed costs would include those that are controllable by the general manager of ElectroCorp. We'll call this fixed costs controllable and at the same time traceable to ElectroCorp as a segment. This is again controllable by the general manager. In this case, we have 800,000. 2 million minus 800,000 is 1.2 million. This line item is called segment controllable margin. Segment controllable margin, 1.2 million. What has been deducted here so far are the variable costs and the fixed costs that are controllable by the segment. Meaning to say, everything that was deducted are within the control of the general manager. Fixed cost controllable may include the salary of the staff of the plant manager, etc., as long as it is within his or her control. Next, we have those fixed costs that are not controllable by the general manager of ElectroCorp, yet it is traceable to the segment. An example would be the depreciation of the power plant. In such a case, we know that it pertains to ElectroCorp as power plants are operated by ElectroCorp. However, it is not within the control of the general manager. You cannot stop the machines from depreciating. We have 1.1 million, the difference of which will give you 100,000. This 100,000 is called the segment margin. 100,000. At this point, everything that has been deducted all pertain to the segment's operations, whether it is within the control of the segment's manager or not. Segment margin, 100,000. Now, we are going to deduct one final point or item for deduction. You have the allocation of the common costs by Ella company, the top management. In this case, it is 800,000. 25% will be allocated to this segment. Allocation of common cost. 25% of 800,000 is 200,000. This would give you an operating profit or loss of negative 100,000. And thus completing your segmented income statement. Now, preparing the income statement is one thing, but it is also another thing when you know how to use it. Remember, in responsibility accounting, the purpose is to have a performance evaluation measure for the purpose of motivating the persons involved. How are we going to use this segmented income statement? when it comes to attaining its purpose. First, if our intention is to evaluate the person in charge, that is the general manager of Electrocorp, we are going to look at the segment controllable margin. In this case, it's 1.2 million. If we want to evaluate the person, we're going to use the segment controllable margin. What is the rationale behind this? Well, if you are the person who's being evaluated, you want to include in your measures only the things that you can control. This would include variable costs and the fixed costs that are within his control. Next, what if you want to determine the performance of the segment? In this case, we're going to use the segment margin if we're going to evaluate the segment. Rationale: the segment margin would encompass everything that pertains to the segment being evaluated, including non-controllable costs. So the difference in the performance evaluation of the manager, subordinate manager, and the segment would be the fixed cost that's non-controllable yet traceable to the segment. Take note, we are not supposed to use operating profit or loss the way it is being used here for purposes of evaluation. Why? It can be distorted by the fact that there are allocations of common costs that are from top management. Of course, if you're in top management, you're going to incur a lot of costs. And since the top management is not going to directly earn, it will simply allocate it to the operating segments. However, this is arbitrarily being done. Again, if we want to evaluate the person in charge, the general manager, the subordinate level manager, use the segment controllable margin. Use the segment controllable margin. If you want to evaluate the segment itself, use the segment margin. That is how you use the segmented income statement. Now, for the segmented income statement, we are going to use this for profit centers and investment centers. Now, for investment center, we have to take into account the fact that the accountability of the manager would include revenues and costs, that is, when combined, would mean profits, as well as the effective utilization of the investments. That is, whether the investments are worth investing. Now, when it comes to an investment center, however, measuring the segment margin or segment controllable margin would not be sufficient. Why? Well, if we have a segment margin figure of 100,000, what does it mean? Is it good enough for the responsibility center? For a profit center, it wouldn't be a problem. As in a profit center, what we need to do is simply to earn profits. But in an investment center, the story would be different. We need to make sure that the profits would be worth it relative to the size of the investment. For example, 100,000 margin would be good for a 500,000 investment. However, 100,000 margin would be too small when the amount of investment is 1 billion. As a result, when it comes to investment centers, we would have other financial performance measures. This would include return on investment, residual income, and a variation of residual income, which is the economic value added. In the next video, we are going to talk about these other financial performance measures that are applicable to investment centers. Like, share, and subscribe.